being the person that I am, I wasn't too sure at the time. This was when I was very first getting started in the insurance world. But this is how I learned about annuities and became a believer in them. Is like, okay, well, I'm a problem solver. Let's figure out the problem. How do you solve a problem? First you have to identify what the problem is and start asking questions. So I just got on the phone with every insurance company, because what he had was like 6 or 7 different annuities with different insurance companies. And I just got on the phone with him and started calling and saying, what is this? What does it do? Why do we have it? Why is the value down? And asking all of these questions. What are the fees? And I just made a list for every single one so that we could compare and figure out why were some successful and why were some not. And I realized in that moment, these indexed annuities were the reason that these accounts were not losing any money, and the variable annuities were. And I realized that is the core difference. Okay, these are losing money, these are not. So easy fix. Let's turn these into these. And that's what we did. That's what we started to do. And he has, did amazing with those. Really did awesome all through the next run up as when things started to recover. So I think that going back to the Great Depression, I think just like me, in that moment, when you start to see, hey, this person's investments are doing well and mine are not, everyone started migrating to these annuities, okay? They started saying, this is what we want. We want to be invested in these. So investors, it says that in this article, investors placed more trust in insurance than in banks following the Great Depression. And thanks to FDR's New Deal, there was a greater emphasis on savings, which the public overwhelmingly responded to. And it was so popular that corporations threw their hat into the ring and developed group annuities for pension plans. So now we have our pension plans.
And if you're trying to call in or would like to call in with your comments or questions about annuities or other questions, you can reach us at 777 here out of Palm City on WCNO. Reach us at 772-221-1100. You're listening to the Mindie Molina Show.
Thank you, Frank. Yes, please call in and give us an update on what type of annuity that you have. I'd love to hear a little bit about what everyone is invested in, and if we're still seeing more variable annuities or if we're starting to see more indexed annuities.
What if they're a shy person? Could they come in and sit with us to find out what kind of annuity they have? They
can call the office, and if you don't want to be on the air, you can also leave your information and with the station, and we'll get back in touch with you, not on the air. So going back into these annuities, once now it's becoming more prevalent in the United States. In the 50s, the variable annuity arrived. Why? Again, because mutual fund stocks were starting to boom, and there was it was during the 60s that assets of stock mutual funds doubled. So variable annuities were a new strategy that essentially encompassed that. It was an annuity that had that within. Oh, I think we have a caller.
Well, not coming. Just keep going. It's
okay.
Not coming in yet.
Not coming in yet. Okay, so they created this strategy in order to take advantage. They wanted to partake in that big bang.
Potential growth.
Yeah, of the growth. And they did. It was successful. So guess what? Big boom in variable annuities during that time. Everyone was getting a variable annuity, and they were being successful. So then So then, unlike other investments, the indexed annuities began with a bigger bang, right? Rather than this progression of people slowly going into indexed annuities, it was not until the big bond market massacre of 1994 where federal interest rates ratcheted up 1.5% in 1 year. Sound familiar? And it caused a massive flux with cautious investors. Okay, so this one article, this guy was talking about the experience. He said nothing was safe. It was tempting to just hide money in your mattress again, which is never a good idea to support your retirement. And as a result, this new variant came into existence known as the indexed annuity. And this type sought to take advantage of the economic climate that existed in the early 90s.
That's
We're good.
I'm just
We're good?
testing.
Yeah.
Okay. And so this is from Susie Orman. I know a lot of you have probably heard of Susie. Frank, have you heard of Susie Orman?
Yes.
Absolutely. Okay. This is a quote from Susie Orman about this time. She said, in its efforts to keep up with mutual funds, the insurance industry introduced yet another kind of annuity in the mid-90s, the indexed annuity. It was created to compete with the very popular index funds and mutual funds that track a stock market index. I have to admit, concluded Orman, I like the concept of the indexed annuity for the right investors.
For the right investors.
And this is the same woman who said, quote, if your financial advisor recommends a variable annuity, fire your financial advisor and find another one.
Yeah.
End quote. That's Susie Orman. So she's in line with me on the annuity concept because I agree. I think that the indexed annuity is a great concept and it's reliable. The variable annuity, I'm not that big of a fan. So at that time, and I want to talk, I'm diving into this a little bit because I want you to understand that the landscape of where we are right now. So when we move into where the annuity space is right now, today,
Come a long way.
yeah, today fixed annuity sales hit a record $28.7 billion in the second quarter of last year.
People are looking for safety.
Yeah, up 79%. 79% more than what is typical year over year. 79% more money went into these indexed annuities than ever before. And what does that tell you? It's a perfect alignment of what we saw when they were initially created. People are looking for protection, right?
Stability.
And it's mainly the baby boomers, the ones that are in retirement or about to go into retirement.
Protection of principal.
They are seeking downside protection. And I don't blame them. You know, according to the index standard, anyone 65 years and older has experienced 6 of the 10 worst market declines in the last 122 years. So think about that.
Wow. Now, if you want to call in, you can reach us. This is a live program on the Mindie Molina Show at 772-221-1100. That's 772-221-1100. Call in with your questions, comments, or stories on annuities or your investing performance or portfolio questions you might have.
So if you're 65 and older, then you've experienced 6 of the 10 worst market declines in the last 122 years. And before we started the show, Frank and I were actually talking about this because he was just reading about life insurance, right, Frank? You can piggyback off that it's the same thing in what the guy was saying about the interest rate growth. The market going back like the first part of 100 years was like averaging 4%, right? Mm-hmm. And then in the last 20 some years, it was. Do you remember?
Well, this gentleman that I was listening to was talking about the market returns from the Great Depression to 1980. And I don't remember the exact numbers. It was a small return figure, like less than 5%. And then the difference between 1980 to 2000 with this huge tech boom and bubble that burst, right?
Which a lot of you lived through and experienced.
Right, higher rates of returns created these various products that the insurance industry was trying to keep up with, like you were talking about, the variable products, trying to create the space in the insurance industry to also get some market upside potential, but that's not been the historic overall long-term trend of the markets.
Right. But and so they say what the markets have averaged, but one of the problem is what you were just saying. It's very skewed towards that one era, right?
That's right.
Of what it does typically average. Thank you for that input. And and then how we are transcending into where we are today in the market, and why are we seeing so much money go flowing into these indexed annuities? And a big part of it, again, baby boomers, retirement. Having that experience of going into these market turbulent times, I've seen a lot of losses. They're aging into a place where they're just not willing to take those chances anymore.
Now, when you're referring to these indexed annuities, you're typically fixed annuities, right, where there is guaranteed return.
Well, there's 4 types. The one I'm referring to is a fixed indexed annuity. The fixed annuity is just a standard rate, which I'm going to get into. I'm going to get into all 4. I'm going to go over all 4. And there's one more point I want to make, and that is the Think Advisor, this is a website, recently reported that a 60-40 portfolio,
60 equities, 40 fixed income or bonds,
right, suffered its worst performance ever during the second quarter of 2022. And the primary purpose of that 60-40 portfolio, which is a very standard, thing.
balanced portfolio.
Yeah, it's what people go to, when investors pile into bonds, if stocks go down, therefore driving up prices. And
that had been the case.
Until
the long period of history in recent past where
right.
the interest rates have been suppressed.
Exactly. So as the Fed has increased rates to combat inflation, both stocks and bonds have performed poorly, which is not what we're used to. But it's one of the reasons it's kind of like that rule isn't working anymore.
Bonds are starting to make their way back in yields, though the prices may be coming down. The yields, as the rates are going up, the yields, there are inverse relationship there.
So that's how we think. Aside from baby boomers just really not wanting to be partaking in the attraction of having an opportunity for these big gains is not as strong as the attraction of saving and protecting what you have. What is the quote that I always say by Warren Buffett that I always mess up and that you have to correct?
2 principles.
Yes.
Don't lose your money. Rule number 1, don't lose your money. And your second rule is don't forget rule number 1. Exactly.
And it's insane to protect what you have to risk what you don't need, or something like that. It's insane to risk what you have in order to get what you don't need. Going to that concept of approaching retirement. The closer we get to retirement or being in retirement, it's just insane to take that chance. And now as we're seeing more turbulence in the markets, we are looking for more security. So I wanted to, going back to what Frank said, address these types of annuities. Before I do, I'm going to go over the 4 types of annuities. This is the perfect time for you to pull out your statement, log into your account, call your advisor, whatever you have to do. Now is the time to see what type of annuity you are invested in specifically, because these annuities all work different ways, and it's not just this general approach. You really need to know what it is that you're invested in, and most importantly, is it the good, is it the ugly, is it the bad?
And certainly, folks, if they're interested, they can come and sit with us for no-fee consultations to go over any and all of the details of their portfolios, to include annuities, to make sure they're on track for their retirement and have the goals that they want to achieve in their life or in their retirement are being planned adequately and correctly to the best of their ability. Certainly, that's what we do.
Yes.
Come sit with us.
Yeah, there's no charge. We just sit with you. There's always a consultation of really just getting to know each other and doing a review of what it is that you have and seeing if there's something that we can do to make it better. That's the whole point.
Feel free to call in at 772-221-1100. This is the live broadcast on WCNO, the Mindie Molina Show. You can reach us at 772-221-1100.
Okay, be the first caller. Call in and tell us, and let's talk about the annuity that you have. I know there's somebody out there that has questions. So let's go over the 4 types of annuities. Okay, number 1, now that we have the history of annuities and just how powerful they are and how solid they are and historic that they are and relied on by everyone from the Egypts, the Romans, the royals, the pastors,
and certainly
schools,
companies in our country that have been around
huge
for more
corporations,
than 100 years.
And what is the speaker that Tony Robbins, he wrote a book about money and talks all about the indexed annuity specifically and why it's good, and talks about some of the ultra wealthy people that he's interviewed and why they invest in annuities. And one of the reasons is the growth, the upside potential, especially in indexed annuities, and then the protection, locking in your income, locking in your lifestyle, basically saying that no matter what happens in the markets, no matter what happens in the economy, I'm always guaranteed to get my income. And that's what they want. That's what locks in their lifestyle. The other reason is because it's creditor proof. Okay. So if you have a substantial amount of wealth and you want to protect that wealth, I specifically have people come to me because of this feature. It's creditor proof. It means if you were to be sued, the annuity is protected from that. The other thing is that it goes directly to your beneficiaries, so it avoids probate. This is its own form of, it's its own little entity that just goes straight to your beneficiaries. Could be some of the fastest funds that they receive in legacy planning. Okay, so there's a lot of really awesome added features to annuities that wealthy people take advantage of. So what are the different types? There's 4 different types. So the first one that I'm going to talk about is the simplest form. That's the fixed annuity. I call this the glorified CD. Although it's not a CD, a lot of times we understand how CDs at the bank work. And a fixed annuity is given a simple term. And as rates are increasing, we're seeing a lot more money going into these fixed annuities because they do offer higher rates than your typical CD rates. Okay. So you deposit a lump sum. Let's say you put in $100,000 into a fixed annuity and it's paying 5% for 5 years. Well, for 5 years, you're going to get your 5%. And after that 5-year term is over, it may just come up available. It'll be free as in liquid. You'll have access to it without any penalty. But some of them will even lock in, like say it's paying 5%, now it pays 3%. And these are all hypothetical numbers. I'm not quoting anything, but just to give you an idea, I have seen when I first started, so now we're talking, let's say 2009, some of these fixed annuities were paying 9%, locked in, guaranteed for 10 years. And you couldn't give them away because interest rates at the bank were good too. And people were not as eager to get into them as they were more of a fixed index style. But think about that today. Like I always think, man, had I known, how powerful that 9% guaranteed for 10 straight years. And then after that, I think it went down to like 5 or 4%. And then that was locked in for the rest of your life. So I have a client right now who has a couple $100,000 in basically this cash account. It's completely liquid at an insurance company and it pays 4% every single year. And it's been doing that for probably 2 decades now. And that is a fixed annuity. It's not based on anything to do with the market. It's a fixed rate. It's guaranteed. That's it. And it comes with all those extra features that I said. The death benefit going straight to your heirs. And also it's creditor proof. What's another one, Frank, out of the 4?